In July 1946, in the streets of Budapest, a street sweeper was photographed pushing a pile of paper debris into the sewer. Upon closer inspection, the debris wasn't trash in the traditional sense. It was money, specifically the Hungarian pengo, just 2 years prior. That pile of currency represented a lifetime of labor, savings, and security for a middle-class family. By that summer morning, however, prices in Hungary were doubling every 15 hours. The currency had mathematically ceased to function as a store of value, reverting to its physical form, colored paper with ink on it, worth less than the calories required to burn it for heat. We often look at such events, whether in Weimar Germany, Zimbabwe, or Venezuela, as historical anomalies or the results of localized incompetence. We convince ourselves that it can't happen here, within the fortress of the developed world's reserve currencies. But money is not a law of physics. It is a social construct based entirely on trust. And history reveals a terrifyingly consistent pattern. When a government is forced to choose between defaulting on its debt or debasing its currency to pay the bills, it almost invariably chooses the latter. The destruction of paper money is not an accident. It is a policy choice, often the final one a failing monetary order can make. The question, then, is not merely speculative but deeply practical. When the ledger breaks and the currency dissolves, what remains? What are the assets that stand firm when the tide of liquidity washes everything else away? To understand how to protect wealth, we must first understand the mechanism of its destruction. Hyperinflation is rarely a sudden event. It is the terminal phase of a long-term disease. It begins slowly, often decades before the crisis, with the accumulation of debt that exceeds the economy's ability to grow. Initially, this debt is managed through low interest rates and moderate inflation, a process economists call financial repression. It transfers wealth from savers to the state quietly, almost imperceptibly. But eventually, a shock occurs. A war, a pandemic, a supply chain collapse that forces the government to print money aggressively to maintain solvency. At this tipping point, the psychology of the public shifts. This is the moment Austrian economist Ludwig von Mises described as the crack-up boom. People realize that their money will buy less tomorrow than it does today, so they rush to spend it immediately. The velocity of money explodes. It is a game of musical chairs where the music speeds up until the chairs vanish entirely. In this environment, the definition of an asset changes fundamental. It shifts from that which generates a yield to that which cannot be printed. The first and most historically resilient fortress against this monetary entropy is the asset class of commodities, with gold and silver sitting at the apex. This is not about fetishizing shiny rocks. It is about recognizing the difference between financial assets and tangible assets. A bond is a promise to pay. A stock is a claim on future earnings. A bank deposit is a liability of the bank. All of these have counterparty risk. If the system fails, the promise can be broken. Gold, however, is not someone else's liability. It is an atomic element. Its supply is geologically constrained and costly to extract. For 5,000 years, through the rise and fall of Rome, the debasement of the British pound, and the collapse of the Soviet Union, gold has maintained its purchasing power. However, the role of gold in a hyperinflationary scenario is often misunderstood. It is rarely a mechanism for becoming wealthy. It is a mechanism for staying wealthy. In Weimar Germany, while the mark went to zero, the purchasing power of an ounce of gold remained relatively constant, allowing those who held it to buy up entire city blocks from desperate sellers who held only paper. But there are nuances to this protection. Governments are aware of gold's power. In 1933, the United States famously confiscated gold from its citizens to prevent them from hoarding it during a monetary reset. Furthermore, gold generates no cash flow. It sits in a vault, incurring storage costs. Critics argue that in a modern, digitized economy, the friction of trading physical metal makes it a clumsy tool for survival. Yet its track record as the ultimate extinguisher of debt remains unbroken. When confidence in the sovereign evaporates, the market inevitably seeks a neutral reserve asset. And historically, that asset has been gold. The second category of survival assets moves us from preservation to production, productive land, and real estate. If gold is the shield, land is the engine. During periods of currency collapse, the population still needs to eat and still needs shelter. These are non-negotiable biological imperatives. Farmland, timberland, and residential real estate represent utility that cannot be inflated away. But the specific type of real estate matters immensely. In a hyperinflationary environment, the most powerful position is to hold a cash-flowing asset financed with long-term, fixed-rate debt. This is known as inflating away the debt. Imagine you owe the bank $1 million for a farm and hyperinflation strikes. The government prints trillions to stabilize the system. Suddenly, a loaf of bread costs $1,000, but your mortgage remains fixed at the nominal number of $1 million. You can effectively pay off the 30-year mortgage with the income from a few months of crop sales. The debt becomes meaningless, but the asset, the land, retains its real value. This transfer of wealth from creditors, the bank, to debtors, the property owner, is the defining feature of inflation. However, real estate is not without significant risks during a collapse. It is immobile. You cannot put a farm in your backpack and cross a border. This makes it an easy target for the state. Governments facing insolvency often turn to aggressive property taxes, or even nationalization to seize value. Rent controls can be imposed, freezing your income in nominal terms, while your maintenance costs skyrocket in real terms. We saw this in the 1970s and in various European crises. Therefore, the safety of real estate is heavily dependent on the respect for property rights in the jurisdiction where it is located. It is a high-reward strategy that requires a stable political environment, which is often exactly what is missing during hyperinflation. The third asset class is perhaps the most controversial, representing the bridge between the old world and the digital age: portable, non-sovereign stores of value. Historically, this role was played by foreign currencies. In Argentina, Lebanon, or Turkey today, the asset that survives local inflation is simply the US dollar. People instinctively swap their dying currency for the hegemon's currency, but this raises a terrifying question for the modern era. Where do you go if the dollar itself is the currency in crisis? If the reserve currency of the world debases, there is no safe fiat lifeboat. This brings us to the debate surrounding Bitcoin and decentralized digital assets. Proponents argue that Bitcoin is the first engineered solution to the problem of monetary debasement. It has a mathematically finite supply, 21 million units, that cannot be altered by a central banker or a politician. It is portable, seizure-resistant if held correctly, and operates outside the traditional banking system. In places like Nigeria and Venezuela, we have already seen populations turn to digital assets not for speculation, but for survival, to preserve capital and move it across borders when the banking system shuts down. However, we must approach this with intellectual honesty. Bitcoin is a volatile, nascent asset. Unlike gold, it does not have thousands of years of history. In a true systemic collapse that threatens power grids or internet infrastructure, its utility could be compromised. Furthermore, regulatory crackdowns are a legitimate threat. Governments do not like competition for their currency. The debate between Bitcoin as digital gold and Bitcoin as a speculative tech stock is still being waged in the markets. Yet its properties of scarcity and decentralization make it a unique hedge against the specific failure mode of central banking, the irresistible urge to print. It is also vital to mention a fourth, often overlooked asset, equities or stocks, but not just any stocks. In the Weimar Republic, the stock market index rose to the stratosphere in nominal terms. If you owned shares in companies that had tangible assets, factories, mines, railways, and pricing power, the ability to raise prices as fast as inflation, you survived. The currency collapsed, but the factory still existed, and the machinery still produced goods. However, the volatility was nauseating. Price-to-earnings ratios often compressed to single digits because no one wanted to hold paper earnings. Ownership of productive businesses remains a viable hedge, provided those businesses are not reliant on complex, fragile supply chains or excessive variable rate debt. As we analyze these asset classes, we must acknowledge a competing perspective from modern economists. Many argue that a true hyperinflationary collapse in a major economy like the US or the Eurozone is highly unlikely. They point to the Japan scenario, secular stagnation and deflation, as a more probable outcome. In a deflationary bust, cash is king, and debt is a death sentence. Holding gold or real estate in a deflationary crash can lead to short-term losses. This is why diversification is not a platitude. It is a survival strategy. The future is opaque. We are navigating between the Scylla of inflation and the Charybdis of deflation. So what is the practical takeaway for the individual watching the debt clock spin out of control? It is the realization that the 60-40 portfolio, 60% stocks, 40% government bonds, is a construct built for a disinflationary world that may no longer exist. If bonds are return-free risk in an inflationary environment, the defensive investor must pivot toward scarcity. The three assets we discussed, commodities, productive land, and non-sovereign stores of value, share a common DNA. They cannot be printed. The psychological shift required here is profound. We are trained to measure our wealth in currency. We look at the number in the bank account. But in a currency crisis, the number is a mirage. The goal is not to increase the number of dollars you have, but to increase the purchasing power you control. It is about measuring wealth in ounces, in acres, and in barrels, not in units of fiat. The tragedy of hyperinflation is that it wipes out the prudent middle class, the teachers, the nurses, the pensioners, who did everything right according to the old rules. They saved cash, they bought bonds, and they were liquidated by the inflation tax. The wealthy, who understand the game, borrow cheap money to buy real assets, effectively shorting the currency. This exacerbates inequality and social unrest. But understanding this dynamic empowers you. It allows you to step off the treadmill. You do not need to become a doomsday prepper to recognize that the math of the current fiscal trajectory is unsustainable. You simply need to acknowledge that insurance is necessary when the house is built on a fault line. We are living through a great monetary experiment. Never before has the entire world operated on a fiat standard simultaneously. We do not know exactly how it ends or when. It could be a slow, grinding devaluation over 20 years, or a sudden loss of faith that happens in a week. But we do know that throughout history, those who held the paper promises of the state eventually held nothing, while those who held the real things that sustain life and society rebuilt the world from the ashes. The currency in your pocket is a medium of exchange, and a useful one, but do not mistake it for a store of value. History is littered with the confetti of currencies that promised stability and delivered ruin. The true store of value is found in the finite, the tangible, and the productive. Diversify into the real, because when the music stops and the paper game ends, reality is the only thing left standing.